To kick off the show, Steve.
Brian, thanks very much. Many in the Federal Market Committee, according to the April minutes, saw a June rate hike as unlikely. They didn't rule it out, but they basically said the data, they did not expect the data to support or provide them the confidence they needed to hike rates in June. There were a few, you could imagine the hawks supporting a June rate hike. Now, in a story that we've been talking about here, most of the FOMC rejected, including an explicit warning of a rate hike in the statement prior to the meeting where they hike. They said 100 times they are data dependent, and you're just going to have to make the judgment over the state of the economy versus the Fed's criteria for knowing when the Fed will hike rates. Now, on the economy, the Federal Reserve saying that the first quarter economic weakness was mostly or largely transitory. And they did cite another story we've been talking about, this trend of weak first quarters that has been in the data over an extended period of time. Specifically, in the last first quarter, they blamed severe winter weather and the West Coast port slowdown as reasons for the first quarter weakness. Most expected growth to resume at a moderate pace. Why? They cited low interest rates, high consumer confidence, and rising real incomes of average Americans. Now, there were concerns, and among those concerns was a worry that when the Fed increases interest rates, that rates could spike. And they cited three reasons or concerns about internals of the market. Let me bring you those. One is an increased role of high-frequency trades and traders. Number two, decreasing inventories held by broker-dealers. These are stories we've been talking about on CNBC lots here. And again, more assets in bond funds. So there's this concern out there that when the Fed does hike, there could be a spike in rates. Other concerns were that the effects of weaker oil prices and the stronger dollar could last or linger longer than they currently expect. The stronger dollar was talked about quite a bit. Among the ills of it, depressing exports. Finally, the last concern over growth in China and troubles in Greece. So, Brian, back to you with the majority of the FOMC, or many on the FOMC, rejecting a June rate hike, saying it's unlikely at this point, and only a few supporting it.
Okay, before we get to our guest, though, Steve, I'm going to put it right to you, because as I listen to your excellent analysis, and I'm pulling up here the minutes on my screen and doing some keyword searches, the Federal Reserve has told us in no uncertain way they are going to raise rates soon, because they're saying, hey, it's not June, which means it may be coming. You talked about wages. They're talking about inflation getting back to 2%. We had L.A. raising their minimum wage as well. Wage inflation is on its way up. They're using the T word for transitory for the first quarter. To me, Steve, just as a layman looking at this is the Federal Reserve saying, get ready, market, because an interest rate increase is coming. Agree or disagree?
I agree. I think that's right. I think it's out there. I think the market expects it. The story right now, Brian, is one where the market generally expects it to be September or later.
Yeah.
But stay tuned, because if that data turns, if the wage data turns, if the job data turns, all of those things could even put June or July back on the table.
And Melissa, before we get to you, I just did my little word search. I like to do these just to kind of get an idea as to how much they're talking about one thing or the other. They use the word patient 5 times in the minutes of the March meeting. They use the word patient 0 times in these minutes. No mentions of the word patient. That's a goose egg, Melissa.
Steve, why don't you stick around here? Let's get some instant market reaction here. You know what? Bob and Rick, we want to look at the market reaction. You take a look at the financials and you take a look at the bond markets. You're not seeing much reaction in either. Bob, let's start with you.
I think the key word here is that magic word, transitory. Once again, the Fed's saying it's all basically transitory issues in Q1. Now they've got another month to show that it's not transitory. There's some things that have been helping them, obviously, like housing starts. Retail sales have not been so helpful overall. I think you're going to see some comments, if I look at it more carefully, about more optimism on the labor market front. But you can see on an intraday basis, really, we haven't moved at all. And even, as Melissa mentioned, banks, if you put up the KRE, the regional bank ETF, not seeing much movement there as well in the overall markets. I think the key thing down here is when are they going to actually raise rates? Most people down here, guys, feel they're in the one and done camp. I'd say the majority of people down here. One rate hike, 25 basis points in September, and many people here feel they're actually going to issue a very explicit statement that they're only going to do it at one time for the year, maybe even a formal part of the Fed statement. Guys, back to you.
All right, thanks so much, Bob Pisani. Let's get to Rick Santelli in Chicago. I take it back, Rick. We are seeing a little bit of reaction now in the bond market.
Yeah, absolutely. And we'll go in the order where the action and reactions were the swiftest. Dollar index, without a doubt. We'll talk about a U-turn, down then up and now higher, up a 0.5 cent.